What do you think of this dynamic? The market just continually pushing against the Fed, not believing what Powell says, and the Fed has to keep coming out and proving the market wrong. How long can it go on?
Well, when you look at the long history of Federal Reserve forecasts, not only about the economy, generally the consensus tends to be not that great as a group of forecasters, but as to their own behavior, they're pretty awful at it. And in fact, when you go back a year from now, even after inflation had ticked through 2, 3, 4% CPI, go back a year ago, the Fed was still talking like, hey, you know, we're going to be lower for longer, and there isn't a whole lot of expectations we're going to change. So the street is appropriately skeptical that the Fed is going to do what it says. Also keep in mind that I think the street, Wall Street and finance, is much savvier as to the realities of inflation than the Fed, which tends to be more academic, whereas the street is much more pragmatic. So the street knows goods inflation has already come way down, and they also know services have rolled over, but it just hasn't showed up in the models that the Fed is looking at.
Well, let's keep talking about the street and about the idea of consensus, Barry, because there seems to be a great deal of consensus right now on what is going to happen next year. And that is we are going to end up at essentially the same place we are now, but it's going to be a trip downward and then back upward in order to get there. Do you get nervous when there seems to be that kind of consensus? Because when I hear everyone singing the same tune, I feel like it's more likely they're all going to be wrong.
Yep.
Yeah, the notable times when everybody has been saying the same thing. I remember back in the fall of 1999, everybody was convinced trees grow to the sky and there's no stopping. And go back to March 2009 and, hey, markets are going to zero, the economy is over and credit is frozen, and we'll never see any sort of recovery. That consensus has a tendency to reflect human emotions. And when the crowd gets really enthusiastic, hold on to your wallet because bad things are going to happen.
Don't we price in, though, events? I mean, yesterday we were talking to Matt Maley at Miller Tabak, and he said we need to go down to 15 times forward earnings before we can, see an end to the bear market. That's historically what happens in a recession, then turn back around. On the other hand, Catherine Rooney Vieira was just in here with us, and she said, maybe the market has seen past that and is already pricing in the recovery. Can you just skip past pricing in a recession if you're that confident that a recovery comes on the other side?
Everybody is so focused on the here and now, this moment, we sort of lose context of the bigger picture. We've discussed the concept of mean reversion before. Let me just remind everybody, from 2010 to the end of last year, markets had gained 13, 14% a year. That's nearly double historical averages. So while we're all coming up with these wonderful narratives explaining what's going to happen, I'm comfortable with the concept that you can't grow at double market rates for much more than a decade before there's a little bit of mean reversion. So is it the Fed? Is it earnings? Is it inflation? Maybe, or maybe this market just ran too far, too fast on fiscal stimulus, on zero rates. And hey, now we're kind of resetting. It does look like the markets have priced in a mild recession. Hey, down 20%. That's a mild recession. I don't know if the markets have priced in anything more damaging or a hard landing.
Well, if we could take one stock as an example of what you're describing, Barry, in 2021 or 2020 to 2021, Tesla was up about 58%. Then it's down 69% this year. Can we just get your hot take on what is going on with a stock that used to be so high flying, worth worth more than $1 trillion at the beginning of this year, and has just seen all of that, or a large part of that, completely evaporate? It's been obliterated.
Sure. So let's look at this in 4 phases, 2 up, 2 down. The first phase was, hey, Elon Musk slapped a bunch of laptop batteries in a Lotus, a little roadster, and essentially that was the birth of the new EV industry. And for a decade, they had that industry to themselves. They were way ahead of everybody else technologically, over-the-air imports, the interface, the management of charging, the charger network. Nobody was even close. They were a decade ahead. So that was phase one. Phase two was when everybody kind of figured out late 2019, early 2020, or maybe it was late 2018, early 2019, that, hey, as soon as Tesla starts to become profitable, they're a lock for being added to the S&P 500.
Which
every trader I know, every hedge fund I know, all front ran the major indexes, saying this has to be bought by BlackRock, Vanguard, State Street, everybody else. And so we're going to get in ahead of it. And that's how you end up with a $1.2 trillion company worth more than all the other automakers combined. Now, the back half of that. So now 1.2 trillion is ridiculous. Competition is coming. Ford, Mercedes, BMW, Hyundai, go down the whole list of all the hot new EVs that are out. That's before we even get to startups like Rivian and Lucid.
Right.
And so competition starts to take some wind out of their sails. The wild price competition, suddenly they're not dominant market share as far as the eyes can see. Eventually, they're going to give some back.